Peter and I are tax controversy attorneys, or at least we used to be before the pandemic hit. Our clients used to be small businesses kind of on the bubble of viability. So we would help bars, restaurants, nightclubs, adult entertainment areas, and other kind of businesses that would get into trouble with payroll tax, sales tax, have audits, needed to somehow come back into compliance. These businesses were hanging on by a thread, and with one bad day, they would get behind on their taxes. So once the pandemic hit, Peter and I knew that we were going to have to dig down deep and figure out ways to keep these small businesses going. So first we started with the PPP, as I'm sure most of you are familiar with. That program was the biggest lifeline to businesses at the time. It was immediate money, or relatively immediate money, that was completely forgivable. So it was going to be borrowed and then forgiven as long as you used it for, the appropriate buckets. Well, in the beginning of the CARES Act, you weren't allowed to use PPP and ERC together. So we started with PPP, worked through all those iterations with our clients and with other folks. And then in December of 2020, Congress changed its mind and said, okay, actually, you can use these two programs together. You just can't use the same dollar twice. So then Peter and I started working with our clients and getting them the employee retention credit. It was unbelievable. We were able to pay all of the tax liability while also getting refunds on top of it for clients that were eligible. At that point, Peter and I started kind of an information campaign to get clients that weren't on the bubble of viability the employee retention credit, and that is kind of what prompted us today. In addition to the employee retention credit, there are a lot of programs out there that just aren't getting enough attention for small businesses such as yourselves. So there are the WOTC, or the R&D, which we'll get into, these kind of programs, plus just other tax strategies of entity formation and bonus depreciation that we think might help you in your business endeavors. So all that being said, I'm going to kick it over to Peter.
Sounds good. So we're not going to spend a ton of time on ERC, but because I'm sure you guys have heard of it and you're getting drilled with it, and you're getting texts and you're getting calls and people are stopping by and all that kind of stuff. So we don't have to spend a ton of time on it, but there's a lot of junk out there with it. And IRS is finally starting to acknowledge that, and they have done a couple of additional notices this week that have come out, geared largely towards practitioners. But even in last October, they're saying, look, some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. So a lot of the content for this presentation is credit related and tax planning related, but one of the most effective things you can do in tax planning is not doing it wrong, right? Don't create risk for yourself and liabilities for yourself by doing it wrong. And so we're just going to quickly run through some of the eligibility analysis for ERC, and then just talk through some of the big issues that I think a lot of these mills are not taking into consideration, which is creating risk for these taxpayers. If any of these things it triggers anything, and you go back and talk to who you worked with, or you got to work through this stuff because it's creating risk for the business. Rebecca's not paying attention.
He tries to trap me, but I was paying attention. I was unmuting myself. As you notice, I say things like, I'm going to kick it to Peter, and then Peter just stops talking. It's fine. I'm here and not sleeping. So what is the employee retention credit? What are we talking about? How can you get it? Peter's right. We're not going to go into quite the detail we typically do, but we are going to go through it because one part of tax planning is getting free money. So If you haven't gotten it yet, or you think you might have underclaimed, and if you think you might have overclaimed, we should talk through that. There has been a lot of stuff that's come out just this week about people improperly claiming this credit. I know Peter kind of did his wet blanket slide earlier, but I am less of a wet blanket, and also abundantly cautious by people overclaiming this credit. The phone calls we have, like on a daily basis, for people who filed with other companies are pretty staggering, pretty shocking. But anyway, how can you qualify for the credit? You need to be an eligible employer. What does that mean? Carrying on a trade or business during the calendar quarter for which the credit is determined. You have to be operating. And there's two ways to qualify: either a significant reduction in gross receipts, or a suspension of operations or restrictions due to a government order. Significant reduction in gross receipts is the easiest way to qualify. Peter and I tell everyone to do this first. Look and check and see if your gross receipts quarter over quarter match these amounts. So for 2020, you need to be more than 50% decline. For 2021, you need more than a 20% decline in order to qualify. Now, in 2021, if you qualify, if you have that 20% decline, the next quarter, you're automatically eligible. This is something that people have a hard time wrapping their head around. We have a client whose gross receipts went down one quarter by 22%. Next quarter went up 3,000%. He's like, how could I possibly qualify for Q3? Like, because the rule says that if you qualify for Q2, then you qualify for Q3. No questions asked. This isn't PPP where you have to check, I'm concerned about an uncertain economy, or explain why you need this money. This is a tax credit that if you're eligible for it, you're eligible for it. There is no declaration that you have to state that you needed this money for any purpose. And moreover, the significant reduction in gross receipts doesn't have to be because of COVID. You can have lost money because you closed 3 of your business locations in January of 2020. You can lose money because you lost a contract, and you would have lost it anyway. Doesn't have to do with COVID at all. It's just whether or not your receipts declined during this period of time. The other way to qualify, and this is where Peter and I spend most of our day, is whether or not a government order, so that's federal, state, and local, was issued that restricted your business, either suspending operations completely or partially restricted due to COVID-19. So you need to have a government order. The order has to be because of COVID, and that order has to limit your ability to do something. So for restaurants, you guys had indoor dining in 2019. If indoor dining was more than a nominal portion of your business, meaning more than 10% of your business in 2019, when indoor dining was suspended, Larry Hogan on March 16th said, y'all can open, but you can't have people eat on premise. Well, that's a portion of your business that was suspended due to a governmental order, and most likely you'd be considered an eligible employer. But what happens when you're able to open at 50% capacity starting in June of 2020? You're no longer fully suspended, but the government order had more than a nominal effect on your ability, or may have had more than a nominal effect on your ability, to provide goods and services. So what does that look like? It means that the government order had more than a 10% effect, meaning you could have done at least 10% better had those restrictions not been in place. So normally without social distancing, you can fit 20 tables in your establishment. With social distancing, you can fit 12. Normally you fill 85% of your tables. Well, what does that look like? That is a more than nominal effect on your business operations if you're not able to serve the amount of people that you would have otherwise. And this goes.
I don't know if you were going to say anything more.
No. You can add anything you want to the restaurant stuff.
No, I think that's right. I mean, I think that the thing that restaurants are going to struggle with is, the analysis for nominal effect when they said you could be open, but then, you know, you had capacity restrictions, you had physical distancing, you had to keep tables apart. The 10% test there, that nominal effect is of the whole. So, you know, you've got to consider what that physical distancing did in relation to everything else. So carry out, you know, DoorDash, delivery, everything. And understand if given everything, you know, the fact that you couldn't have a certain number of people in the indoor dining space, right? Maybe built a large outdoor space during the pandemic to be able to work. That's where this stuff gets hard, you know, and that's where you've got to go back and think through what your experiences were and how that all plays into each other. That is probably the place where restaurants, you know, have you know, potentially some issues there. There's a third method of qualification. Just real quick, recovery startup businesses were added by the American Rescue Plan. Just some definitional stuff that you have to work through. By definition, a recovery startup business began trade or business operations after February 15th, 2020. And in addition to that, it had on average less than $1 million in gross receipts. That stuff, you know, the gross receipts analysis comes into play with controlled groups. We'll talk briefly about that. You know, this credit's only available for quarter 3 and quarter 4 of 2021. So, you know, it's basically the idea that you took a risk during a pandemic, started a business, and you survived, and you had employees in quarter 3 and quarter 4. This is capped at 50,000, so 100,000 total if you're qualifying as a recovery startup business. Just this may be something that if you started your restaurant, you know, after February 15th, maybe missed. Then just some special issues to talk through quickly. We're not going to go through this stuff in depth because it's tremendously boring. But this is also the stuff that the other, you know, mills aren't really working through. So, you know, ERC is built on top of existing tax code, and the statute references certain code sections to be considerate of. There are situations in the tax code where multiple entities, even though on paper they're separate and distinct, are going to be considered one employer. And there are existing code sections to make sure that, you know, tax credits aren't, you know, computed too high, right? Or to make sure that highly compensated employees aren't able to game the system and to the detriment of lower paid employees. So just, you have to know, you know, what other businesses the owners own. You have to understand what their spouses own. Do they have minor children? There's just some weird stuff where you may be considered, multiple businesses may be considered a single employer. That can, you know, jam up how the credit is done. In addition, you know, you want to make sure that majority owners' wages aren't counted, haven't been counted, and if you have family members that are working in the business, they can be considered deemed owners as well. So if that went into your computation of a qualified wage, it's incorrect. There are safe harbors for what happens if you acquired a business during the pandemic, and what to think about, you know, gross receipts analysis pre-pandemic. Then just quickly, the due dates for this, if you haven't filed yet, you know, the credits related to 2020 are due on or before April 15th, 2024. Add a year for credits related to 2021. The assessment statute has been extended certainly for quarters 3 and 4 of 2021. The rest of the years, it's only a 3-year statute, but when you go to file this, you're giving the government at a minimum 3 more years to come in and audit you. Then lastly, just make sure if you filed, hopefully your preparer, whoever you worked with, advised you that due to the operation of basically code section 280C principle, says that if you get a credit based on wages paid, you lose the deduction for wages up to the amount of the credit. And what the government has said is that you should go back and you should amend your business income tax return to which the credit was attributable, or to where you initially deducted the wages and back those out, and you're going to have to pay tax on it. So make sure you're doing that as well. With that, we will move on from ERC because again,
Just real quick, does anyone have any questions before we move on? I know we just flew through that. If you do, we're happy to answer them afterwards or tomorrow or whenever you'd like, but you could also just ask them now. Okay.
all
Watson.
right, WOTC. Work opportunity tax credit is, another tax credit that was set to expire at the end of 2020. The Relief Act at the end of 2020 extended it for wages paid or incurred for the next 5 years. So this is available. It's another tax credit. It's not as lucrative as ERC, but you can see here it's anywhere between $2,400 per new hire to $9,600 per new hire. It is encouragement to hire individuals from certain targeted groups, and we'll go quickly through the targeted groups, but if you guys are interested in this handout or slide deck, we can send it to you so you can have that reference material. But it's basically a 40% multiplier on qualified wages. Qualified wages are generally capped at $6,000. In the case of certain targeted groups, like a qualified veteran with a service-connected disability and at least 6 months of unemployment, qualified wages go up to $24,000, and so that's how you get up to that $96,000. The credit offsets federal tax liabilities dollar for dollar. So this is different than ERC, where it's a refundable tax credit and they're sending the check to you. This is not going to do that, and we'll get into some of the mechanics, but it is a dollar for dollar. If you at the end of the day owed $2,400 in tax and you had a $2,400 work opportunity tax credit, now you pay zero. So it's dollar for dollar. So we'll just go quickly through the targeted groups. I've got all the various elements to it, but you'll see there's a layer of oversight here as well. But qualified 4A recipient, qualified veteran, qualified ex-felon, designated community resident, vocational rehabilitation referral, qualified summer youth employee, qualified SNAP benefit recipients, qualified SSI recipient, long-term family assistance recipient, qualified long-term unemployment recipient. So those are the targeted groups that the government is saying, look, if you hire these folks, we'll give you tax credit. But this, again, the mechanics of this works completely differently than ERC. So in this situation, the employer must pre-screen and obtain a certification from the designated local work agency, which is also called a state workforce agency. In Maryland, that state workforce agency is the Department of Labor. If you're interested in contact, you can reach out to me and I can put you in touch. But how to pre-screen. So pay attention to this. I mean, you've got to do this stuff in the right order. You've got to capture certain dates in order to make sure this works. So on or before the day that the job offer is made, a pre-screening notice must be completed by the job applicant and the employer. That pre-screening notice is called Form 8850, pre-screening notice and certification request for the work opportunity tax credit. Again, 4 dates that are really important, okay? You need to know the date that the applicant gave information about being a targeted group member. You need the date that the applicant was offered the job, the date that the applicant was hired, and the date that the applicant started the job, and pay attention to the order. You got to get that right as well. But for doing, a couple of things for folks you may be hiring anyway, take $2,400, take $9,600, whatever, is available depending on their targeted group. Couple other things. You have to submit this within 28 days of the individual beginning work. And it's going to be evaluated by that state workforce agency, in our case, the Department of Labor. And then once you get, the certification, it's just a matter of claiming it on your tax return. It's just a general business credit. That's Form 3800. Form 8884 rolls up into that, 3800 rolls up into whatever tax return you otherwise would be filing. So the point of this is, if you do that kind of stuff, you get the pre-screening, make sure that you've got it all ready for your prepare to go in and actually claim the credit. Again, WOTC's not refundable, but it can be carried back 1 year and forward up to 20. So you'll get the opportunity to take advantage of it for sure. And now to Rebecca.
Look at that. I was ready anyway. Okay. So far we've gone through the employee retention credit. We've gone through the WOTC. Those are, credits based on, what kind of employees you hire, whether you were an eligible employer during the pandemic. Now we're going to talk about depreciation. So when you buy something for your restaurant, say it's a dishwasher, Peter said a walk-in fridge that I'm assuming is very expensive. You want to do it before the end of the year. So it's March, you've got plenty of time. And then think about how you want to depreciate it. So bonus depreciation used to be so in general, the way you depreciate something is over the course of its natural life. Section 179 allowed you to depreciate 100% of the item up to a certain amount and in certain categories. Bonus depreciation used to just be 50% all at once, and the rest of the depreciation was over its natural life. Under TCJA, which is like the Trump tax cuts, colloquially, that changed and bonus depreciation went up to 100%. So the question is, when do you use bonus depreciation? When do you use 179? One interesting thing about 179 is you can take a chunk of your depreciation at once and then spread the rest over, whereas bonus depreciation, you have to take it all at once. As a non-accountant, I think taking it all at once right away is always the best bet. I don't know why you wouldn't, unless you're going to run out of the cap, in which case you want to think about it a little bit more. There is a limit for section 179, which allows 1,080,000. Some state limits are also smaller than that. These items have to be used for your business at least 50%, more than 50% of the time. So if you're buying a car for your business, sure you're using it at least 50% or more of the time for the business. Otherwise, you wouldn't be able to use these tools to reduce your income. And that's the idea, right? Like you're using all of this to offset income, which is going to lower your tax rate. Already went through that part. Hello, research and development tax credit. So that's like the long and the short of depreciation is essentially just be thoughtful about when you buy something, try to buy something before the end of the year, if you're going to buy it anyway, and then talk to your accountant about what method of depreciation you think you should use. Natural life section 179 or bonus depreciation. As the years go on, the bonus depreciation amount is going to go down unless something changes in Congress. Okay, research and development tax credit. The R&D credit is a federal tax credit available to organizations that invest in qualified research and development activities. Why am I talking to restaurants about a research and development tax credit? Well, a lot of what you all do, whether you realize it or not, is research and development. If you are a brewery and you're creating new beers every season, you're by definition, researching, determining what ale. I'm not a beer drinker. I have no idea. I could probably do wine better, but research and development on what kind of ale is going to last longest on the shelf, what kind of hops are going to go in there, what kind of bitter is going to go in there. What you're doing is creating a new product that hasn't been created before. You're not sure whether it's going to work. you're using chemistry, right, in order to do that type of thing. And it's possible that in doing these types of experimentations that you're going to actually qualify for this special tax credit. Another way to think about this is during the pandemic, did you all just start using DoorDash, or did you create your own system? Did you create your own software, your own delivery service, your own, point of sale system, so that way you could interact with your customers that weren't able to come through the door? So these are things to think about as I'm kind of going through what the test is. So the credit provides dollar for dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. So there's a 4-pronged test. So the first prong of that test is permitted purpose or qualified purpose business component test. An activity intended to develop new or improved business component, improves function, performance, quality, reliability. It could be a product, it can be a process, technique, formula, or software. So has your company demonstrated that the information being discovered was to develop a new or improved product, process, software, or invention, which is to be held for sale or lease or further use in your trade or business? Elimination of uncertainty. So I always make this joke, Peter laughs a lot. Adding butter to a recipe, that's not uncertainty because you know it's going to be delicious. It has to actually have an uncertain result. So is intended to eliminate technical uncertainty concerning capability, optimal methodology, appropriate design, process, or product improvement. So has your company demonstrated that it tried to learn something new about the product or process being changed in order to improve it? And has it demonstrated the product could not be improved without first going through this process? How else could you do it? The next prong. Process of experimentation. So implementation of a systematic approach to identify and evaluate different alternatives to achieve a desired result by trying different technologies, several iterations, modeling, and simulation. And then finally, is it technological in nature? So your application of hard science principles such as engineering, physics, chemistry, computer science, and other disciplines. Here's one haywire. So for the R&D tax credit, the idea here is to issue spot. I'm not going to be able to tell you whether or not, your new bread that you invented in the last 3 months that's going to be more stable on your table more so than what you had before is going to qualify for the R&D tax credit. But what I want to do and what Peter wants to do is to give you all ideas of things to think about in order to minimize your tax risk or minimize your tax liability. Next, this goes to Peter. Choice of entity and tax strategy.
Choice of entities. So this is probably the most important thing and the easiest thing that you can do. And there's multiple
Especially
reasons.
in Maryland, for sure.
Multiple reasons why. But making sure that you're being thoughtful about what entity matters. So, from not having an entity at all, being a sole proprietor, it's not a great idea just because it exposes you to a lot of risk personally and in your individual capacity as an owner. That at a minimum you should establish an LLC, and it's disregarded for tax purposes, but it will at least generally provide you with liability protection. When you have multiple owners of entities, you're dealing with, am I going to be a partnership? That's typically going to be a default rule for an LLC or a corporation. It starts as a C Corp, but maybe you check the box and become an S Corp. The tax is treated differently for these, and even after TCJA brought down the C Corp corporate tax rate, the most tax efficient vehicle is an S Corp. And the reason that is because even though you have to pay yourself a reasonable salary, meaning you've got to get a payroll company in place, you've got to actually pay yourself something that's reasonable, and it's more than $5,000 for sure. you've got to pay yourself a reasonable salary that a similarly situated person doing similar work is being paid. But the rest of the income, the profits from the business that don't go to pay the wages of either the owner or the other workers, are not taxed, are not subject to FICA taxes, but they're just subject to income taxes. So you're basically saving 7.65% by not having to pay that additional amount. If you're just in a partnership, it's even less tax efficient because you're paying self-employment tax on top of income tax. And just be thoughtful. Generally, S corps are the most tax efficient structure. You got to do a little bit more work so be realistic with yourself about whether or not you're going to do that additional work, but be aware that it matters what entity and what elections you make with the federal government.
So the pass-through entity PTE considerations. This is what Peter was talking about. So an S corporation is a pass-through entity, so with a partnership. What that means is that the tax burden of the company is getting passed on to the individual. So C Corp, you're getting taxed at the entity level and at the individual level. A sole proprietorship, you're just getting taxed at the individual level. And what he was explaining is that you can, by choosing to be a corporation, you can take wages out of the company and then only get taxed on the profit part at the individual income tax level versus all of your payroll plus income tax level. So as most of you probably remember, when the TCJA passed, the Trump tax cut, it had a disproportionate effect among us Marylanders than it did some other states, maybe like Arkansas, Mississippi, because there was a cap to what you can claim for your state and local tax on your Schedule A. So the cap is $10,000. For a lot of us that live in Maryland, I live in Baltimore City, and I'll tell you my property taxes are very high. And that plus my income tax, I'm over that $10,000 limit, not with that much work. The legislature for Maryland and other blue states, DC, California, a lot of places tried to figure out a way around this state and local tax limit, this deduction limit. And I think DC had one where the state and local tax would be like a charity, and so you could take it as a charitable expense. The IRS did not bless that and said, nice try and no. Maryland said, okay, can't do charitable deductions. What if we say these pass-through entities aren't really people, they are entities, and let the company pay the tax at the entity level. Then when it comes to the individual, they made less money because we're taking the tax out. This is what's known in our world as the SALT workaround, the state and local tax workaround. So the IRS has blessed this. So what companies can do that individuals can't do, I can't do, Peter can't do, but you can do if you're an owner of a company, is now pay your state and local tax at the entity level through your Form 511, make estimated tax payments on the entity level. At the end of the year, you're going to subtract that out, and then you're getting the full benefit that you would have, but for that rule. So it's pretty exciting. We absolutely recommend, if you are a pass-through entity, to take advantage of this. If you are not a pass-through entity, we recommend becoming a pass-through entity and then taking advantage of this. This is just, you're writing the check regardless. It's just a matter of you're writing it from the company rather than yourself individually, and you're getting the saving. That's it. Tax planning in a nutshell with Rebecca and Peter. How do you guys have any questions? Okay, I'll give my little pitch at the end, which is essentially that Peter and I have changed our practice in how we work quite a bit over the last 3 years, where we went from doing tax controversy 100% of the time to working in this special credit division space, working with, obviously the employee retention credit, but EIDL issues, ERC issues, FFCRA, WOTC, R&D, all this stuff in this space. And we've spent a lot of time to learn it all. We are basically like Def Leppard in 1987, and we'll never be more popular than we are right now. Also, this information, what we do is going to have to change again in 5 years because it's going to all expire and it won't matter anymore. So for now, while it's super popular and everyone has it on the tip of their tongue, please feel free to reach out to us and ask us questions. You're not wasting our time. We don't mind. Peter and I give presentations to like the CPA Academy and Maryland Association of CPAs and Maryland Society of Accountant and Tax Professionals. We're training our competition because we just feel it's so important for everyone to be doing this properly. And also because we know this stuff at this point, backwards and forwards and backwards again. And so I just don't want people to think that they're wasting our time and asking us questions. You've done it already yourself. You just want to ask us a quick question. It's no problem. We don't mind answering it. So that's a little spiel at the end. Let us know if you have any questions. And we look forward to hearing from you.